All right. So if we go back to our little slideshow here, Vincent, I've put together the top 10 holdings of each of the, effectively the ASX 200, AFIC and Argo. What, to me, I'll ask you first, Vince, what jumps out to you about this table of the top 10 holdings?
I mean, they are generally the top 10, so it's largely shuffling the chairs on the Titanic. It's about, I wouldn't call them index huggers, but they're very much index aware, and so that you would expect that the top 10 are largely the same top 10 in a different order.
I mean,
Argo's long been a Macquarie supporter, and it's not surprising to see that as their biggest holding.
Yeah, and that's actually what jumped out to me. At the start of 2025 this year, Argo had 7.3% in Macquarie. Now, when we look at the equivalent on the index, it makes up 3% of the ASX 200, where AFIC held 4.5%. And this is where, with our investing, you can't really look at the last 12 months of performance, because with a huge weighting to Macquarie in Argo, particularly over the last 2 months with Liberation Day and Trump, Macquarie has been slammed. And so that would have a material impact to that portfolio.
It would do. But if you look over the longer term, if you look over the last 20 years, the only two banks that have outperformed the overall index is Commonwealth Bank and Macquarie.
Yeah. So I don't know, that kind of stood out to me.
Yep.
You mentioned, just for the sake of educating people, you mentioned that these funds, AFIC and Argo, they're quote-unquote index aware.
Yes.
There's a style that's the opposite of that with funds management, and that's index unaware.
Or agnostic.
Or agnostic. So talk to us about that.
Yeah, so and this is part of the argument as to why many active managers don't outperform, is that in order to get a different result, you've got to do something different. And so when you're running a big fund where you're being measured against the index, so someone who's looking to buy a large, broad-based Australian large cap fund is going to ask the question, well, how do you compare to the index? And the downside of underperforming is worse than the upside of outperforming for the career of the manager. So they tend not to move too far from the index, that it's more about tilting or going overweight. So if you read the reports of a manager and they use words like tilt or overweight, you know that they're staying pretty close to the index, which makes it harder to outperform. So so in these, I would say, the choice of which of the banks you choose, which of the supermarkets you choose, which of the miners you choose to go higher than the market weight is where your outperformance is coming from. And obviously there's a cost of running these funds and a trading cost in maintaining that, and that's a hurdle that you've got to get over.
Now, just for those who are listening, I might just read the top 5 holdings of each of these 3 funds. Argo, in order of weighting, Macquarie, BHP, CSL, CBA and Wesfarmers. AFIC, CBA, BHP, CSL, Wesfarmers, NAB. And then the IOZ index, which is basically the ASX 200 weighted index. CBA, note 10% versus Argo's allocation to 4.7, so half. BHP, CSL, Westpac and NAB. So of those 15 companies that I read in the top 5 of each of these funds, there's a lot of suspects. And when we look at the performance a little bit later on in the slideshow, you will see that it's pretty much very similar when it all washes up.
Yeah. But if you just go back to that list of holdings, the really big thing that sticks out is AFIC's resources exposure is much lower. So the only resource entity in that top 10 is BHP, whereas the actual top 10 includes Wesfarmers and Woodside as well. So the actual top 200 is fairly heavily weighted into resources. AFIC's very much eliminated most of the resources out of that big group, and that will show in the cycle. Whereas Argo's got Wesfarmers, Rio, Santos. So they've got Santos instead of Woodside, which is an interesting choice. And
the Aristocrat.
Yeah, that's
that blows
an interesting
my mind.
one.
Yeah, that's very. And so there's obviously some type of longer term play or core belief, but this is where you get into, these LICs, active management.
Yeah,
that's all it is. They've got a view, they've got a reason, and they double down.
Yeah, and they are relatively cheap active managers.
Yeah,
I mean, AFIC is about 0.18, I think.
Yeah, I've got that. But it is funny because Nick Bradley, who wrote the book with me, The Quick Start Guide to Investing, he's an American.
Yep.
And he says, the ASX 200, it's a two-sector fund of mines and banks, basically. So,
financials and miners, financials and resources,
effectively,
and materials,
whatever the two vibe things are. So let's move on. Vince, do you want to walk us through this slide?
Yeah,
and it is about volatility, and I don't expect people listening to fully appreciate this, but maybe you can just talk people through this.
It's very difficult to look at return as a single measure. What you've really got to be looking at is what's my return per unit risk that I'm taking. And so we measure risk in that context by volatility, which for the maths nerds in the group is technically the standard deviation of the movement in the price. And so...
And just to pick you up on that, when we talk standard deviation in movement from the price, is there a general rule of thumb, but it's a monthly move, a daily move, a weekly, or is it just depends?
Yeah, most people use annualized monthly volatility.
Right.
And it's a fairly standard measure. The number itself probably doesn't mean a huge amount. It's more the direction. And so you've got to look at the two, and we generally plot that on a graph that has performance on the vertical or y-axis and volatility on the x or horizontal axis. And so you're trying to get as far to the top left as you can is the goal.
Yeah, so we want the performance.
You want high performance, low volatility.
Yeah.
Now, you can't actually have that, but what you want to do is get more return per unit.
So for the visual people out there, it's basically a graph with a T and a few dots around the middle of the T, the bullseye.
Yeah. And when you look at the big LICs, they form into two major clumps, which are close to the return and volatility of the index as a whole.
Yeah.
You've got the slightly lower volatility, marginally lower return group, which is your AFICs and your Argos.
It's fascinating that, they're camped together. If we look at if you look at a clock, everyone, and the middle of the clock is the middle of the T, AFIC and Argo are sitting at 9 p.m. or 9.
Which means they're delivering broadly the same returns with lower volatility.
Yeah.
And that's a good thing.
And that's why they are probably the two biggest LICs in Australia.
Yeah.
And it's probably because they have a stable long-term return, low volatility, nothing scandalous. But if we look at the clock face and you look at, say, 1 o'clock, WAM Capital.
Yeah. Now, WAM is high risk, high return. So they're very much a more aggressive investor. They'll take a more aggressive position. They're probably a little less benchmark or index aware. Their returns are a bit patchy. You've really got to pick your period. So over 10 years, it looks great. Over 15, it looks pretty good. But and obviously you can't see it on the graph, but if you compare WAM this is a 15-year graph. If you compare WAM, you get an extra 2.5% per year return, but you're taking 4% more volatility. So your return per unit risk hasn't gone up.
Yeah, so why bother?
So that question is that what you want to do?
Yeah.
There are periods when it didn't do particularly well. And then at the 5 o'clock period, which is probably where you don't want to be, which is high volatility, low return, you've got Djerriwarrh. Now, Djerriwarrh is not really comparable to the others because it uses options to try and create a more stable income return, which obviously doesn't play well in an up market. So it's you know if you're trying to make comparisons, you're going to compare AFIC and Argo, who between them have $1 in every 3 invested in LICs. Like they are the 64-pound gorilla, or whatever the term is.
So just so people can like visualize the clock face with the T in the very middle where the hands are.
Yeah.
In this graph at 3 p.m., you've got the big two that we talked about, AFIC and Argo, in terms of smooth return, pretty good volatility. Realistically, the ideal, as you said, top left would be 10:11 p.m. or 10:11 on the clock face.
And it's pretty hard to get up there.
Now,
certainly in equities, it's pretty hard.
So the ASX 200 index, I would imagine it would be around that 9 o'clock.
It'll be closer to the middle, so it'll have slightly higher volatility and slightly higher return. So it's
because it is not active. Like they can actually take the view, for whatever reason, there's going to be a downturn in mining or something like that, and
so you would expect
pull those levers, whatever.
And there's a bit more sensitivity to market sentiment in the LIC return.
Oh, sorry.
Because they can smooth the return. So when times get bad, people go, oh, look, AFIC looks pretty stable. I'll buy some of that.
How much cash do they usually hold?
Not a lot.
Yeah. I guess, like, if you're investing in a LIC, you don't want to invest to have money sitting.
That's right.
Like, there's just no point.
Yeah. So why pay nearly 0.2% to manage cash?
Yeah.
So I think that's the interesting story. So $1 in every 3 goes into AFIC and Argo. They're big, large cap, value managers, benchmark aware, low cost, diversified. So there's not a lot to dislike.
There's no story here, is there?
Well, I mean, the big reason we don't use LICs at Life Sherpa is because of the added complexity of the price movement around net tangible assets.
Okay.
And that's we might not hold, I don't know if you want to hold that for later.
Yeah, we'll just
that's the main
pause on
reason
that.
we don't.
Yeah. But we'll come back right after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.